Andrew, thanks for joining us.
Thank you very much.
You've announced this proposed demerger of a number of BHP's assets, including some quite attractive assets. Could you briefly explain the philosophy behind the demerger and the decision to create this new entity and the choice of the assets that you're going to transfer into it?
I can. We've been clear for the better part of 2 years and probably longer than that, and it's just started very much under Marius that, we saw real power in simplifying the portfolio and concentrating BHP Billiton on a small number of very large-scale, world-class assets, almost beyond Tier 1. And we said it, strongly. It was going to be, iron ore in the Pilbara, coal, predominantly in Queensland, copper, predominantly in South America and South Australia, and then our petroleum business, with the potential fifth being potash, and that we see as the future as we look at it for BHP Billiton, that allows us to effectively span steel making, energy, and potentially food. We've embarked on the process of simplifying the portfolio, and of course the first phase was very much through trade sales, businesses that we felt were trading at prices that reflected mid-cycle prices for their products, and we were very successful. $6.5 billion of sales, almost all of them achieved at prices that were probably north of the average of market expectations. But we want to get to this simple portfolio quickly and in the most value-adding way. And we concluded for the majority of the remaining assets that it would be more effective to demerge them in the way that we've announced this week, and then tidy things up at the margin with a few more trade sales of things like Nickel West, small-scale petroleum, and what remains of our North American coal business. So that's essentially how we selected the portfolio. And you can see, because we've not included certain assets in there because they've been previously sold or are waiting to be sold, that we were thinking of a portfolio that needed to have assets which were smaller scale, but still assets that were actually high quality in world standards and in the industries in which they played. And that's what we've ended up with. So with this demerger, in all but a single step, we get pretty close to what we would say is the desired portfolio for the next stage of evolution of BHP Billiton, which I think will be a stunningly simple company for its scale, with a very small operating footprint, but still capable, because of the output of that footprint, to be a huge global player in resources and selling to the four corners.
In the context of BHP and the basin assets that you've got, I suppose you could call these assets second-tier assets. There seemed to be a view in the market, which I think is starting to drift away, that they were also second-rate assets. I take it you wouldn't view them in that light.
I wouldn't actually. I don't like either second-tier or second-rate. I mean, when you look at things like Cannington, the largest and probably most profitable silver mine in the world. Things like Alumar and Worsley Alumina. I mean, these are huge, recently capitalized, and in many respects, top quartile performers in alumina. And I could go on. They're just, for what we want to do as BHP Billiton, are in general smaller scale, but in their industries, I think they are top quality assets and very competitive. And and the fact is that as a collection, even though they are probably all trading more or less, maybe not all, but the majority at prices that people would say would be below their midpoint in terms of the cycle, they're still generating a lot of operating costs, 1.4 billion in the year just closed, with, I think, huge potential upside.
Andrew, can I take you into some financial thinking? Australian institutions like capital returns. The Australian small shareholders much prefer higher dividends. Out of this, some of the institutions wanted their old capital returns, but you did not do that and are going to pay higher dividends. Is that a deliberate strategy to go on the side of smaller investors?
We have many investors that we need to satisfy, and you're right. One of the most difficult things to do is, particularly when you operate as broadly as we have, and we have such a wide range of shareholders, which of course is partly facilitated by our dual listing, to have a capital management program that is absolutely what everybody wants. So we always have to find a way of doing as much as we can without compromising value to satisfy the largest number of shareholders. But what we've look, we announced. First of all, we announced obviously an increase in the dividend by 4% with these results, and that is now giving a payout ratio of 48% of earnings. That is top class within our sector. We also said, you're correct, Robert, that we would not rebase the dividend when the NewCo assets leave BHP Billiton. So even though we're losing, a piece of our, if you like, of our cash flow that could allow us to pay dividends, we will continue to pay the dividend at the level as it is today, or announced with the results. So that will actually take the payout ratio into the 50s, and depend at the time and so on, and people can go and calculate it. I would also argue that by giving every shareholder our prorated allocation of NewCo shares, that is a form of capital management. And people can either elect to retain the share, and because they believe in the potential of the company's management to increase its performance, and possibly they have they have, in line with the market, by the way, a positive outlook for the prices that NewCo products will sell at, or they can crystallise that value by selling it for for cash. So we've done an awful lot for a lot of shareholders out there at the moment, and in the meantime, the company is I think doing very well in meeting the commitments we've made. At the full year, we over-delivered on productivity, we over-delivered on capital reduction, so our cash generation was greater than we thought was possible, given the price deck through the half year at the half year result. All of this, of course, has gone to service these capital measures that we've just spoken about, but it's also gone on to strengthening the balance sheet, and therefore, as the balance sheet gets stronger, we have the potential for even more capital returns to shareholders in a form that satisfies the most people.
But do you think that your dividend payout ratio will stay north of 50% going forward?
I don't want to give a prediction like that. I think what we have to, but if I look backward, over 10 years, we've given $64 billion to shareholders, roughly, at a payout ratio of about 50%, and about 2/3 of that has come from dividends and 1/3 has come from other forms of capital management like buybacks.
I suppose the best part of a decade and a half, BHP has pursued this diversified business model built around those concepts of cash flow at risk and base cash flows. Assuming that the NewCo spin-out occurs as planned, does the narrowing of the asset base have any impact at all on the cash flow at risk?
I don't believe so in a material sense. It's a large company by ASX standards, but it's quite a small part of BHP Billiton, and so its ability to, in some way, diversify the portfolio at a cash flow risk basis is somewhat constrained. And a lot of these products, they don't completely. They're not completely uncorrelated with each other. There's a high degree of covariance, and in many cases that covariance has perhaps got greater with time as markets have become more perfect and more open and more global. But I think with what remains in BHP Billiton, by having an exposure to steel making, iron ore and coal, energy, copper, and all of the fossil fuels, and then potentially in the long term, something in potash. That is quite a big spread, and it does two things for us, which we have to have from diversification. One is it helps smooth the cash flows so that we can plan for the long term, and we can do things through the cycle without having to sort of continually change direction in response to market shocks. And secondly, it allows us to think, even longer term, that, if the world continues to progress in the way we think about it, where steel making may become less important, but still strong and growing and a lot of opportunity for us, and consumption or rising living standards, particularly with a growing population in Asia, becomes more critical, then that's going to get increased demand for energy. And we've always said that, we're not quite sure where the world wants to get its energy, so it's good to have wide diversification in energy, which we have. I mean, we're in all forms. We're in copper for transport, very important for energy efficiency and renewables. We're in all the fossil fuels, and we're in uranium for nuclear power, and we can swing our investments accordingly. So that's a nice diversification as well. And then finally, if you think of a very highly efficient world where there's perhaps less growth in the consumption of energy, and people continuing to improve their living standards by eating better, then we have the long-term option of being part of the food industry. And I think that gives us all the diversification we want, and some, even after Newco has left the portfolio.
Had the demerger occurred, say, beyond a year ago, what impact would have had on BHP's continuing financial metrics, the key ones?
That's a good question, actually. There's some of the strongest performance that we've announced at these, I think, very, very positive full-year results has actually come from the Newco assets. Aluminium and manganese and nickel, even though they've got slightly depressed prices, and some of the coal assets have perhaps made the most progress in reducing unit costs and actually, and increasing in very difficult circumstances, their cash generating capacity. Other factors of course, less price have made that harder, and we've learned a lot as BHP Billiton outside of the Newco companies as to how we can improve things, and there are quite a few things we're doing at the moment in driving improved performance in iron ore that are derived initially from things that were pioneered by some of the Newco assets. So I think this is the right time to do it. The knowledge is there, and it's possible if we done it. No, I wouldn't say that. I think this is the right time to do it, and I don't think doing it earlier would have changed the results very much. Now we're ready to do it, and I think now the two companies in one will be able to add their own special sauce to strong, undemerged BHP Billiton, and as a result, performance of both areas will soar relative to being kept together.
Andrew, in the latest results, you improved your productivity by just a little under $7 billion. How much further is there to go? Can you double that or triple it? And by the sound of it, you probably can, because a lot of it came in the Newco assets.
We've said we can do another $3.5 billion on an annualised basis out to financial year 2017. This is now the guiding principle by which ultimately we want to grow this company. I'm not going to answer whether it's doubling or tripling. I mean, I've been, I think, a bit bolder than I probably thought I would be in giving some forward guidance to the market. At the half year we said we will deliver at least this by the full year. We've beaten that, as I said, by $1.1 billion. Now we've given guidance for the next 3 years. But I think it's important because people need to understand some of the potential that's unlocked by this demerger to increase productivity. But we're well into our agenda. But my way of putting it is that we have an awful lot more to do, and an awful lot of the potential that you're starting to see. Broadly speaking, Robert, I see, and we're very much going to try and get it as quickly as we can.
Andrew, PricewaterhouseCoopers are scathing of the Australian mining industry for their productivity, and that obviously includes you. And if it's anything like what they say, you should only be just beginning. There must be an enormous amount still to do.
Well, I mean, we use a lot of benchmarks and we can see a lot of potential. I think in some of those reports, which, are scathing of Australian mining, I mean, there's some good news in that as well. I mean, first of all, these are based on, obviously a lot of exchange rate assumptions. And and I sometimes think for things like this, you're probably better off using things like purchasing power parity. And then I think the discrepancy is not as wide as some people would say. But nonetheless, it is there. I mean, we all know that in the response to, in China and so on, we geared up very fast. And in doing that, we emphasized getting the volume, on the ships and sold, and perhaps spent not enough attention on ensuring that volume was coming at low cost. But there was clearly skills shortages that inevitably meant that costs would rise. I think we're through that now, and the fact that Australia is a go-ahead country, very open to new technology, new ways of thinking, not an unreasonable amount of flexibility, then the stimulus of things like PwC means that there is becoming an Australian response, and I think in many ways what that will do is that it will create, in terms of using technology, the technology of big data, which we use through our systems, the technology of autonomy, better trucks, and so on. I wouldn't overemphasize that. Then Australia can still come back to lead the world in terms of productivity. When you look at it, if you like, on tons per activity, or tons per people, and then we'll see what the cost of those people turns out to be. But I think it's important for Australia that we do offer high-paying employment within the mining industry, and it's not a high-population country, and we want to have well-paid jobs here. So we want to make those jobs incredibly productive through what we're doing, through our systems and our processes, which is most of the game, by the way, and then obviously the investment in leading edge technology as well. So I think it's all to play for.
Andrew, just to follow on from that, if you achieve the last $3.5 billion of productivity gains, you'll have reduced your cost base, increased your volumes by a combination of about $10 billion over 5 years. What does that say about that boom era? And could you have done things differently in that kind of environment?
Of course you could have, but nothing's perfect. I mean, in this world we're always striving for lower levels of imperfection, and we shouldn't be too hard on ourselves, I believe, in the previous period, because we've put a lot of the infrastructure in place quickly in a way that has, I think, provided the supply that the world needed. I think that's been very important for things like geopolitical stability, and and Australia and the investors in that should feel very good about that. And because that's all sitting there now, we can do all these games with productivity to keep that capacity in a way that I think will provide a lot more supply at much lower capital intensity and a much lower cost that will actually, I think, create more sustainable pricing, which I think in turn will actually support further economic growth. So, as you can see, I tend to be, an optimistic kind of guy, and very much that the way I see it. But seeing is believing. I mean, it wasn't so long ago, if we were thinking about getting to 290 million tons per annum in our iron ore business, for example, we'd have looked at quite big capital costs and so on. But by just sitting back with what we've got, making what we've got much more productive, higher utilization, less costs in achieving that utilization, we've seen our way through to achieving that with minimal capital, so that we're talking that we may get there, with a capital intensity of about $50 per annual ton, which is, that is world class as a number, and that's what's possible in Australia, and with some of the investments that have been made, in the previous era. So, that's, and I think, and we're seeing the same thing in coal. And I think in time we'll see that in some of the gas parts of the industry in this country as well.
Andrew, is there any problem with potash? You seem to slow down a bit this year in potash. And what do you think that'll look like in, say, 3 years' time?
I'm not in a hurry in potash. I mean, this is something, as you heard me earlier, it's for the very long term. We want to create the opportunity to build potentially a business in the food sector, if we could call that, on a scale of the business we've got today in iron ore and met coal, petroleum and copper. We've all but secured the resources to do that, and what we think is the best undeveloped potash in the world in Canada. And but we do need to make some initial investments to to be serious about this resource and to be serious to the people of Saskatchewan, and that involves building a shaft, which sounds simple, but it's actually, people don't build shafts that often. We need to take our time, get it right, use leading edge technology to reduce costs, and we're bringing in a lot of know-how from the rest of the mining industry, but also from petroleum, because a shaft's really just like a big well in petroleum to get it right. And to be honest, I mean, I don't want the company to spend too much capital. If we can reduce the burn rate and do it even more effectively, then I'll take that any time, because we're still waiting to see when the market really sends the signals it wants a new greenfield mine. And at any stage, once you have a shaft, you're still 3 years from being able to put first potash. Now you can parallel track some of that, but not a lot. So it's a long process, and and I think by going slow, we can wait and watch the market. We can keep our costs down, and we can master new technology. But also, actually, while we're doing that, all the work that goes on to really think about how you, if you build the mine, how you can do it with the highest capital efficiency and the highest guarantee that you'll be able to execute against that can be done. And one of the things, I mean, you talk about the rush and things not having done as well as people might have helped in the build-up of mining capacity, for example, in the more recent past. Well, run that forward. We now don't need to rush. So we now need to take. So we build in all those product savings from day one. I think, and we probably do test the patience of some shareholders, and I'm very clear that this is something that we need to be modest about, and we can only have one or two of those areas, even for a company like BHP Billiton. But in a way, we're doing the same thing at Olympic Dam, finding ways of developing this project over time with high capital efficiency by taking our time.
So Olympic Dam could be 5 years away, 10 years away. We're using the same process.
We've announced a couple of things recently, that we're getting costs down to the levels of Escondida, which is the most important thing. So it's getting competitive. That we'll continue to have success with heap leach, which will dramatically reduce the processing costs. And and we'll talk about things during the course of this year, how we can, in a more modest but nonetheless determined way, continue to grow the output from Olympic Dam, and think about this as a multi-decade type of endeavour, working on one of the, what if not the best undeveloped copper ore body in the world. Well, only partially developed, if you like, but we're in a very small part of it with the underground at the moment.
Andrew, unfortunately, we're at the end of our allotted time, but thank you very much indeed for your time.
Not at all, thank you. Enjoyed talking to you. See you when I'm back.